Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer in screen. Everything in the video is general in nature. Nothing in this video should be taken as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It is just general in nature only. I want to start with a chart. I haven't started with a chart for a while, and that's this chart here, which is Dixie inverted with what's going on inside the bond yields. And we saw, and I talked about this quite strongly at the start of the year, it was very heavily correlated in terms of how we were working through, particularly pairs. I really liked dollar yen at the start of the year. It was incredibly tight on side of it. And you can see from the chart, it shows that there was a very decent, strong correlation between what was going on in yields and what was going on inside the US dollar as a whole. That is clearly broken down, and that is also from the fact that we now see relatively stable, inverted commas, I'd probably put that out there, with the bond market, which is what you would expect after what was an incredible opening quarter to the calendar year. But Dixie's continued, and there's probably two reasons behind that, and one of them is clearly what's going on in the Biden administration. We saw at the start of the year they put out a 1.8 trillion US dollar package, and then about this time that you saw that breakdown, they put out a second one. There is now a belief, as why when I go to air on this now, it could actually happen after I do this, and I do apologize for it, that the Biden budget will be 6 trillion US dollars, which would be the largest spending package, including inflation hedging, around what's happened since the Second World War. The US antics at the moment is just throw money at it, and it's clear that that's what's happening with the US dollar. You cannot get past the sheer mountain of money that is washing around markets in USD. And that, I think, is part of this movement at the moment, is that the other second and other part of it is that the Fed's backing that, and the Fed's speak, to this point anyway, is winning, that they are not going to taper and that they're not going to move rates. So couple that with the Biden administration's policies, fiscal and monetary policy working together, we're flush with USD, which explains the downward trajectory in that chart. However, something that started to happen in the last week, we have started to see a real tightening in ranges inside pairs, and I need to start highlighting that. So have a look at dollar yen. That is now stuck, and well and truly stuck, between 108.5 and 109.5, or probably even as high as 175. If you look at the one that I think is the most interesting, euro dollar now is really finding it hard to get through the 122.5 handle. It's had several attempts at trying to do it in the last week. It keeps backing away. Are we finally starting to see that uptrend, particularly in euro dollar, coming to an end? Questions are being asked. If you look also something like, cable, Aussie, Kiwi, they're all doing the same thing, but they're not as exciting as the two pairs at the start. And maybe it comes down to the fact that that hesitancy to really keep going with the momentum and that fall in the US dollar, maybe be the fact that the Fed speak has just ever so slightly started to change. And that change is coming around the fact that we're now starting to see more and more talk about discussing, not actually doing, but discussing tapering in the US. And I think the biggest hitter last week was Richard Correlated, the vice chair. He probably put feet on both sides of the wall in terms of where he sat, but he was, as he said, pleasantly unsurprised by what happened in inflation, and that maybe we should be considering, if growth continues unabated, that we need to think about it. But at the same time, he did point to the fact that the April jobs figures numbers were poor, and that the overall transitory effect is still very much in the background. That's a bit of a coin of both ways. And then if you look at what happened, even someone like Jamie Bullard continued to point out, who is a hawk, that things at the moment are transitory and you can't really put it down to being actual and more long term. It may explain why there wasn't a breakout in either direction, but there is a difference. And we are starting to see that Fed speak is becoming more prominent around the idea that how do we get out of COVID accommodation rather than staying the course for the foreseeable future.